Hello students, in continuation of the video of second unit retail store operations, we are here with the topic of motivating retail store employees and employees retention program. Motivation of retail store employees depends upon the work environment in which they are working, salary structure, development, growth, and productivity, incentives, workloads, etc. So here we are discussing the topic create a positive work environment, increase salary, build trust and respect, business promotion, understanding employees, improve productivity, provide incentives, reduce workload. Financial dimensions in retail store. To define operation management, to discuss profit planning, to describe asset management, including the strategic profit model, other key business ratios and financial trends in retailing, to look at retail budgeting, to examine resource allocation, credit and cash management, and inventory management. These are the aspects of financial measures which should be taken care of in retail stores. Planning for profit. Profit planning is done on the basis of profit and loss statement. It is a statement which provides summary of major components of retailer's sales revenue and operational expenses for a month, quarter, and yearly basis. Based on the profit and loss statement, the retailer is able to determine if it is making a profit or a loss. A profit and loss statement consists of the following major components: net sales, cost of goods sold, gross profit, operating expenses, taxes, and net profit after tax. Net sales. It represents the net sales amount after deduction of sales tax or central sales tax. Discounts given here, we are categorizing two types of sales tax. One is state sales tax, which is known as SGST in GST terms, and CGST in central GST term. So discounts given to the employees and customer returns due to defect in apparel. Next term is cost of goods sold. It represents the total expenses incurred for manufacturing of the goods as well as the cost incurred for procuring goods from other vendors. When the retailer has to decide on the cost of goods procured from other vendors, it has to include freight charges, less cash discounts, or rebates received against the procured goods. Third term is gross profit. It is the difference between income and cost of goods sold. Fourth point, obviously, gross profit is other than the net profit. Net profit is deducing the taxes, while gross profit is income, difference between income and cost of goods sold. Operating expenses. These are all those expenses that are necessary to run retail business. Retail business after the cost of manufacturing. Finance charges. It includes company's overdraft facility with the banks for taking short-term loans as per the banking limit for meeting working capital needs. Hence, then comes depreciation. It includes depreciation as per income tax rules on the assets of the retail company. It will include plant and machinery of the factory besides assets like fixtures and display articles, computers, etc. at the store level. Tax. It is the income tax payable to the government as per statutory rules. In the above statement, the same is not shown. Net profit after tax. This is the true profit of the retailer after deduction of all expenses and taxes as applicable, which is less than the gross profit. Okay, so in gross profit, we are not deducting the taxes while only cost of manufacturing is there. But in net profit after tax, net profit is deduction of taxes and operating expenses. All. Next slide, we will move on to asset management. Here we have done profit after profit planning in financial dimension. We are moving to asset management. Balance sheet represents the corporate strength of the retail business, comprises retailers' assets, liabilities, and net worth as on the date of the balance sheet preparation. Generally, as per the statutory rules, every retailer must prepare balance sheet at the month of the financial year. In India, financial year is from 1st April to 31st March. Parameters for retail assets management. A retailer must ensure that the investment done by various stakeholders in the retail business is managed very well, and to assess this performance, retailer needs to keep under control the performance on parameters like net profit margin, asset turnover, and financial leverage. We will see here the balance sheet of a specialty retail store. It is divided into two parts, the liabilities section and the asset section. Liabilities section is in the left hand side of the sheet statement, and asset section is on the right hand side. Liabilities consist of current liabilities, expenses to employees, accounts payable, short-term loans, taxes payable, etc. And the total liabilities here you can see. Then fixed liabilities are mortgage and long-term loans, and equipments also comes under fixed liabilities. Then we are considering on the right hand side current assets, that is cash on hand, inventory, accounts receivables, and fixed assets are property, building, and store fixtures. So you are clear with the total liabilities and the total assets which we need to study in the net profit margin. Is it clear? Yeah. Now, inventory management. Inventory management is the heart of the store's operation, as the right type of merchandise assortment ensures that the retail store is able to achieve maximum sale possible. Any mistakes in the right monitoring and management of inventory may result in loss of sales, result into higher proportion of slow moving merchandise, more markdowns, and finally loss of profit margins. The retail team for better management of inventories need to be well trained on issues like stock assortment, pricing, category management, markdowns, replenishment, sourcing, etc. The correct understanding of inventory issues will ensure the most efficient and effective management of inventories, which will result in the best use of working capital and higher return on investment. Next is credit and cash management. Again, to remind you, we are discussing the financial dimensions in the retail sector. Credit management has become the important part of retail organizations because more than 70% of the billing transactions at the billing counters in organized retail stores is done through credit card transactions. In case of credit management, following decisions need to be made as highlighted by Berman and Evans and suitably elaborated here below. Retailer will have to clearly state whether credit cards are acceptable, and if yes, then whose credit cards, Visa card, MasterCard, or American Express are acceptable. This should be mentioned clearly in the retail stores, and schemes also to be made clear. Then next step in financial dimension is allocation of resources. It is important for a retailer to understand the quantum of the resources being allocated to a particular form of asset and the productivity of the asset, because these two factors have important impact on the asset management and budgeting. Magnitude of expenditure. Spending are of two types: capital expenditure and operating expenditure, which are administrative and operating expenses meant for running the business, also called as working capital. Secondly, productivity. Under magnitude of expenditure, we have capital expenditure, which is a long-term investment in the fixed assets, and operating expenditure, which is known as working capital. While in productivity of expenditure, for measuring the efficiency of the expenditure made in various elements of cost, retailer needs to have an effective method for doing so. One of such effective methods is to measure the productivity of the expenses that helps to determine the efficiency of the given expenditure. Retailers can use the following measures, among others, to improve the productivity of its resources: improving employee performance by regular training programs, improving sales per square foot through advertising and sales promotion. These are the motivating factors for employee retention as well. Reducing costs through automation in warehousing processes and billing methods, keeping employee costs under control by way of complementing permanent staff with the temporary employees during peak selling periods or part of the day, taking help of suppliers in doing certain tasks like price labeling, keeping track of replenishments, offering discounts on slow moving merchandise, and so on, closing non-profitable or less efficient old stores and opening new stores with better trained staff, automated systems, and efficient checkouts and security methods. Moving on to the next slide. Retailers can use the following measures. Uh, yes, here we complete the employee retention and motivation uh, uh, part in the retail stores, as well as financial dimension of the retail store. Thank you. We will continue with the balance scorecard in the next video. Thank you, students.